Hello and welcome back. One more quick video. I want to follow up on my last video, which discussed why we need to look at PE ratios and why, because we're in an elevated PE ratio now, I'm kind of expecting growth moving forward to slow down and just to be cautious. If you want, you can watch that video here. I'll link to it. But here's a great chart I found. Again, it's really important to do your own research and but when you do some research, you find some amazing things. And that's really what I'm here to do is because I'm making these videos for all of you, I'm learning so much and getting the data to back it up. But what we have here is um, they've sorted PE ratios by their percentile. So again, lowest percentile means that on the lowest, they divide all companies into 10 buckets, and the ones with the 10% of highest PEs versus the 10% lowest. So here's the 10% lowest over here. Here's the 10% highest. And they said percentage of times annualized returns were negative 10% or worse. So again, this is they return negative 10% per year. As you can see, on the 1 year, it's basically the same. Again, the highest PE ones were most likely, but any company kind of has a decent chance. But over a 2, 3, 4, 5, or especially 10-year period, the bottom half of companies, the companies with the lowest PE, had almost no chance of having significant capital destruction. Again, negative 10% per year is significant capital destruction. Over 10 years, you're talking losing 90% of your money. Over 5 years, same. You're talking like 80% of your money if it's 10% compounded. Um, Maybe it's not 80, it's close to it though. And you can see this highest percentile of companies are the ones where you're most dangerous. So this is my big thing, not to be cautious of companies, but be cautious of those companies that are in the ultra risky growth ones with the super high PE ratios. Um, because those are the ones where Warren Buffett has this statement like, rule number one, don't lose any money on an investment. Make sure you're not losing money. Rule number two, don't forget rule number one. If you don't lose significant capital, the upside will take care of itself. If you don't have any negative 20, negative 50% losers, you're going to get the market on whole goes up and you're going to find a couple winners. So really you want to make sure you're not finding these massive losers where you're losing half your money or 60% of your money or even worse. You want to find ones where at the worst case you're losing a little bit of money. Oh, the thesis didn't work out. Like let me think of I'm thinking of an eBay where over a long period of time it hasn't. I wouldn't say it's been great, but if you invested here, you basically didn't lose your money, but you didn't do super well either. So you can live with that. If eBay was one company in your portfolio, but you had seven or eight others, maybe you also had Amazon, and Amazon did extraordinarily well for you. So you didn't lose money on this one. But if you had a company that maybe an AT&T that, and we're ignoring dividend here, but over the last, here we go, if you invest in 2000, you lost 50% of your money over a 5 year span, 60%. So you really want to avoid these ones, the ones where you're going to lose a ton of money. If you lose a little, you can survive a bullet wound. You can't survive a shot to the heart. So really try to limit your downside. And so this is really trying to say there's the most risk with these super high PE companies. And actually, if I can real quick, Scott Galloway. I personally like Scott Galloway. I know some people are not his biggest fan, but long story short, he had a video where he showed the percentage of companies that are going public, IPOs, that were not profitable. And you can see here it's typically been about 75%. It dipped during the dot-com bubble to around 25%, and we can see here now it's the same. So these companies are either unprofitable or they'll have minuscule profits, which means they're going to have very high PE. So again, these are the riskiest companies, these SPACs, these non money losing IPOs. They also have the most potential upside, but a lot of them are going to go bust. So, if you hit the Googles and the Facebook, the next Google or Facebook, you're going to do really well. But for every Google and Facebook, there's probably 10 pets.com and other companies that are just in the dustbin of history. So make sure you're really being careful with which companies you're investing in and do your due diligence. That's my biggest advice is, don't just take a hot tip from a YouTuber, even if it's me, do your own due diligence, but I try to help you understand the numbers and give a little more context. So let me know your thoughts below. Let me know if there's any stocks you're curious about that you think, hey, is this overhyped or is it this is a great opportunity. Let me know in the comment section below. Happy to analyze it, look into it more, and provide some more data. So thanks so much for watching, and talk to you next time. Cheers.